Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, I want to touch on the subject of hyperinflation. So I'm getting a bunch of direct messages on Twitter and also on Instagram almost every day from my followers and fans who are asking me what my thoughts are on hyperinflation. So this is not a doom and gloom channel. It's not a fear-mongering channel. I simply present facts and allow my audience to use their own independent critical thinking skills and their own due diligence to form their own opinion. So all I'm going to do is present the facts, and this is more of opinion than facts, but I want to analyze a pretty long tweet thread by Dr. Michael J. Burry from about 3 weeks ago or so. So let's get right into it. If you know Michael J. Burry, he was actually the person in The Big Short that predicted basically the great mortgage crisis of 2006, 2007, 2008, and he made about $800 million doing so. So this is his Twitter profile here, and the problem with his profile is that he never has any tweets. As you can see here, he always deletes all of his tweets. Right now he has 2 tweets from February 28th talking about a Vietnamese restaurant. So how do I expand this thread? Well, I did a little bit of digging, and there's actually a person here that created the Michael Burry archive. So he basically takes screenshots from Michael Burry's timeline, so none of his tweets are really deleted. He has screenshots of all of them. So this is Michael Burry's Twitter thread, and I want to go through it in its entirety. That way you can actually get inform your own opinion. So basically on February 20th, he talked about this. The U.S. government is inviting inflation with its MMT-tinged policies. So for those of you that don't know what MMT is, I highly suggest you do deeper due diligence. MMT simply stands for modern monetary theory. It's basically where the government's financials are not treated like a household like you and I. They can basically print their way out of trouble. And that's my take on it, but obviously do your own due diligence. So he's saying brisk debt to GDP, M2 increases while retail sales, PMI stage 5 recovery, trillions more stimulus and reopening to boost demand as employee and in supply chains cost skyrocket. Hashtag paradigm shift. So for those of you that don't know what M2 is basically the money stock, which the Fed conveniently discontinued about a couple weeks ago. They did recontinue it in this link up here, but for this conversation, this is the original chart. If you don't know what M2 is a measure of the money supply that includes cash, checking deposits, and easily convertible near money. M2 is closely watched as an indicator of money supply and future inflation and as a target of central bank monetary policy. So if you look at the M2 money supply, if you're not familiar with this chart, if you look at the x-axis down here, you can see that it starts in 1985 or a little bit before that, and it goes all the way to 2020. So I'm going to do you a favor and zoom in a little bit. Let's 2005, and you can see during the first quarter of 2020, look at what happened to the money supply. So you have to realize these are billions, thousands of billions of dollars, aka trillions of dollars. So you can see that right before the great financial crisis of 2008, we were at about $7.4 trillion in M2 money stock, and if you fast forward after the pandemic, you can see $19.4 trillion basically 13 years later. And look at this right here. It looks almost like a hockey stick growth. So without getting too far into that, you can basically see his case of, hey, there's more money in circulation. So if I go further into this tweet thread, he is quoting a book or an article here. And since this isn't the original tweet by him, I can't really understand what the source is, but this is coming from some sort of book talking about inflation in Germany after World War I or just before World War I. So the life of inflation in its ripening stage was a paradox which had its own unmistakable characteristics. One was the great wealth, at least of those favored by the boom. Many great fortunes sprang up overnight. The cities had an aimless and wanton youth. Does that sound familiar? Prices in Germany were steady, and both business and the stock market were booming. The exchange rate of the mark, the German Deutschmark, against the dollar and other currencies actually rose for a time, and the mark was momentarily the strongest currency in the world on inflation's eve. Side by side with the wealth were great pockets of poverty. Greater numbers of people remained on the outside of the easy money, aka soft money, which I talk about a lot on this channel, looking in but not able to enter. The crime rate soared. So if I go to the next picture here, Accounts of the time tell of a progressive demoralization which crept over the common people, compounded of their weariness with the breakneck pace to no visible purpose and their fears from watching their own precarious positions slip while others grew so conspicuously rich. So I want to stop right there. This quote, again, I'm not sure where this came from because it's not his original tweet and I have no source for this. Whatever this is discussing sounds an awfully lot familiar with the sentiment that I'm seeing in the streets of the U.S. Again, not a fear-mongering channel, just my independent, unbiased observations. Almost any kind of business could make money, Nicola. Business failures and bankruptcies became few. The boom suspended the normal processes of natural selection by which the non-essential and ineffective otherwise would have been called out. So this is basically talking about companies that have no business making money or having no business having the market cap in which they have today, like a lot of these companies, which I'm not going to name. They're kind of being able to survive and actually thrive in environments like this. Speculation alone, while adding nothing to Germany's wealth, became one of its largest activities. The fever to join in turning a quick mark infected nearly all classes. Everyone from the elevator operator up was playing the market. Sounds a lot similar like it does today. The volumes of turnover in securities on the Berlin Börse, sorry, I'm not German, I don't know how to pronounce that, that's basically the Berlin stock market, became so high that the financial industry could not keep up with the paperwork, and the Börse was obliged to close several days a week to work off the backlog. Hashtag ROBINHOOD down. So he's referring to Robinhood being down, which we all know happened about a month and a half ago with GameStop and all that. So if we continue the thread, he said, all the marks that existed in the world in the summer of 1922 were not worth enough by November of 1923 to buy a single newspaper or a tram ticket. That is actually not an exaggeration, you guys. If you've seen picture from the Weimar Republic, people were literally going to the store with wheelbarrows full of money because they weren't able to buy simple things like bread, milk, cheese with the paper. It was literally being devalued at breakneck speed. That was the spectacular part of the collapse, but most of the real loss in money and wealth had been suffered much earlier. So if we continue, throughout these years, the structure was quietly building itself up for the blow. Germany's inflation cycle ran not for a year, but for 9 years, representing 8 years of gestation and only 1 year of collapse, written in 1974. So whatever source this is was written in 74. So he's referring to the period of 1914 to 1923, again after World War I, and he's basically correlating this with 2010 after quantitative easing 1 after the 2008 financial crisis to 2021 gestation. So he's basically saying, hey guys, this is where we're at right now. We're Germany from 1914 to 1923. When dollars might as well be falling from the sky, aka stimulus checks, money printing, management teams get creative and ultimately take on more risk. Paying out debt-financed dividends to investors or investing in risky growth opportunities has beaten a frugal mentality hands down. Okay, so he actually links to a Wall Street Journal article here, which I cannot click on because these are just screenshots because he deletes all his tweets. So if I keep going, consumers do not expect inflation. This is a chart of the 5-year inflation expectation by consumers going back to the last big one. Half of us were not alive during the last one, and I'll show you that time period real quick. 2, betting on inflation has been a widowmaker trade on Wall Street. So you can't see the timeline here. I have to click into the next one, which I'll do right now. So if you look at this chart, he is referring to expected change in prices during the next 5 years. The last big one, which he referred to, is just before 1980, which you could see the median price increase was 10%. And then ever since then, it's been lower and lower and lower and lower. And you can see where we're at right here in 2020. Historically, this chart shows good places to be during significant but relatively moderate inflation. In a modern hyperinflation, best assets might be somewhat different. In Venezuela, Argentina, Zimbabwe, etc., even farmland wasn't safe from confiscation or punitive taxation. So if you look at this chart, this is talking about long commodities, short long-term bonds as inflation rises. So real assets, which I talk about all the time on this channel, you can see here went up by 73%. So what do I mean by that? I'm talking about the inflation isn't going into milk, cheese, bread, things like that at the grocery market. It's going into assets. Why do you think the stock market is an all-time high? Why do you think real estate is at all-time highs? And then you can see it's followed by commodities, platinum, real estate, et cetera, et cetera, et cetera. So that is actually the end of that entire tweet thread. There may have been other ones in there, but that's basically all that I could find in that archive. Again, this is not like a fear-mongering channel. This is simply presenting facts that have happened throughout history. So the thing about me is that I genuinely enjoy history. I follow geopolitics. I follow things that are going on in the world. That's why I love finance, because it's kind of a culmination of all those things. And if you don't study history, you may miss things like this. I'm not saying hyperinflation is coming to the United States. There's a lot more factors going on now than there was in 1914 in Germany, especially with the demand for U.S. dollars all across the globe, and obviously the dollar being the global reserve currency, and then also other factors such as the military, petrodollar, things like that. But those are topics for another conversation. My point is that he could be onto something here, because history doesn't necessarily repeat itself, but it does rhyme. When you've printed multiple trillions of dollars in just a 13, 14-month period, as we've seen here in the United States, it gets people's heads scratching. So maybe I'll create another video on classic inflation hedge investments. But right now, a really good investment against inflation is a 30-year low fixed rate mortgage. Because if you think about it, if inflation is going up X percentage points per year, and your fixed rate is much lower than that, you are paying down that mortgage with much cheaper dollars later and later down the road. So that's just one idea. There's a bunch more, but I may make a completely separate video about that. So I know this isn't typically what I do, but I think that this was worth reporting. I originally read this thread when he tweeted it, because I do follow him on Twitter. I didn't think it was worth making a video about, but since I'm getting all these questions and comments in my DMs about hyperinflation, this is just one take on it, and it's not kind of like a mainstream media take. It's just one person's opinion. And I will say that Michael Burry, Dr. Michael Burry, has typically been bearish on certain things, even though he does have 3 really big call options in his portfolio right now. And he does manage about almost $250 million of wealth. He has about $225 million of assets under management. So he makes a lot more money than I do, so I pay attention to him, and I think he's a lot smarter than me too. So I hope you got value out of this video, you guys. If you like this, give it a thumbs up. If you have any questions, leave them down below. As always, thank you for watching, and have a prosperous day. And don't forget to sign up for the waiting list for my university, Whiteboard Finance University. Thank you so much. Hey, Jerome. Jerome Powell. Jiggity Jerome. What's going on, buddy? Yes, I wear sweatpants during these videos. Oh, nothing. My stock portfolio, it's doing great. Real estate, all-time highs, baby. Love it. These millennials and Gen Z will never be able to afford this stuff. Keep the money printer going, baby. I'll talk to you later. Peace.